So today we are going through 4 sections, of course, with the short format here very quickly. So highlights of the last quarter, our business profile, financial results, and finally strategy and outlook. And the most recent highlight is the rebrand of CentralNIC into Team Internet. So CentralNIC, the NIC in CentralNIC stands for Network Information Center, which is what a registry does. And this name has become less inclusive or less indicative of our actual activity over the last 10 years. While it was 100% of our revenue back in 2013, it is now only 1% of the revenue, and we felt a new name would be more fitting. And the name that we've chosen is the name of Team Internet. Here you see the dictionary definitions of team and internet, a group of individuals combining the efforts. Here we talk about our people, our businesses, and our technologies, and internet being the interconnected network that is where we find our customers and partners. And our mission is to connect the two. Next slide, please. Then also only Friday last week, we acquired a company called Adrenalabs. So we've taken a small hiatus from acquisitions of roughly 8 months. And now we came back to the game, buying Adrenalabs, a company that monetizes domain traffic with e-commerce partners, something that is very interesting, given that the US e-commerce market is still going strong. And as you can tell from the statistics on the right-hand side, we've also been able to deliver a very accretive deal, $2.4 million of consideration for $700,000 of EBITDA. So way less than 4 times EBITDA. So this should nicely drop through to our earnings per share. Next slide, please. So coming to the figures for the first half of this year, which Billy will lay out in more detail later. So our gross revenue went up by 18% to almost $400 million in the first half of the year, whereas our net revenue, so that is our gross revenue less all the pass-through costs like traffic acquisition costs and registry fees, increased to $91 million. And then we managed to almost convert 50% of this net revenue into EBITDA, EBITDA up 60%, just demonstrating the cost discipline the company has been exercising. And given that we were also managing the items below EBITDA and are currently conducting a share buyback program, to which we will come later, our earnings per share went up by 34% to more than $0.11 just in the first half of this year. And then the small spike in the amount of net debt of the company is basically Billy will lay out in more detail, but it has to do with our maiden dividend, which we paid in June, the share buyback that we started, and with some deferred consideration payments for very successful acquisitions in the past. And again, the cash flow is nearly the same as our EBITDA, just demonstrating the strong cash conversion of the business. Next slide, please. So how does this growth break out between the two businesses? And here we are comparing 12 months numbers, so trailing 12 months numbers, as compared to the first half that we were seeing on the other slide. So in the online marketing business, we had a 36% organic growth when we compare the trailing 12 months ending the 30th of June this year to the trailing 12 months ending the 30th of June last year. For those who are new to us, the blue part of these bars is the reported revenue, and the green slither on top of it is basically the additional revenue that we would have reported if we would have already done all our acquisitions that are currently constituting Team Internet Group before the beginning of the reference period. But as you can tell, given the few months of hiatus on M&A, the difference is now much smaller. and yet 36% organic growth, I hope you agree, is a respectable number, in particular in this current economic climate. And then we've also been able to instill new life in our domain business, which we refer to as online presence, which has been seeing mid-single-digit growth rates for quite a few years now. And here we were able to take this through both innovation and new data management methodologies up to 15%, growing the business from $148 million to now $171 million in the 12 months just ended on the 30th of June. Next slide, please. And Team Internet being an ambitious company, in all the business that we operate, we aim for not anything less than world market leadership. So in what we do in online marketing, the closest peer that you could find is a US company called System One, not to be confused with System One Group PLC here in the UK. And while back in 2020, we were only doing 42% of the revenue of the world market leader, now in the first half of this year, we already managed to lift up to 97%, almost perfectly catching up. And also in our online presence business, we managed to grow the relative share from 55% in 2020 to 77% in the first half this year. So vastly outgrowing the largest competitor in this segment, and give us a few more years, and we'll try to also catch up fully in this business. Next slide. And how do we actually do this? So you've seen on the slide on rebranding that Team Internet is all about connecting people, building networks between domain registries and hosting companies, connecting news websites to online advertisers. And so what you see here is the constant expansion of our partner network, respectively product innovations. So early in the last quarter, we took our German product review business Vergleich.org into France under the name of Meilleur.fr, trying to tap the French e-commerce market. Then we've been selected as one of only two global providers of critical domain services to the UK government. And then we went later through a firework of new partnerships with unicorn companies like Sovereign, Klarna, Booking.com, and Shopify, basically building new revenue streams outside of our major business relationships with giants like Google and Amazon. And then also we take pride in having been the first company on this planet to introduce an AI-powered domain search. So when you try to register a domain name, it is taken. Typically, the alternatives that are being proposed by our peers are quite poor, something like adding 24 or 365 to the end. And now with AI technology, we can propose proper alternatives. Like you could look up for billygreen.com, the domain is already taken, and then it would maybe suggest best CFO in town.com as an alternative. And this is not only a nice feature, it has materially driven up our conversion rates. So now with the same budget that before bought us 100 new customers, it will now buy us 120 new customers, which it makes a material difference. Next slide, please. So here we come to the share buyback program. So we after our first small test balloon in January, we've in our second program on the 15th of May of initially 4 million sterling, which we've now upgraded to 34 million sterling, with the objective to basically buy the entire amount of shares that the AGM has approved, being 10% of the share capital. And we keep the market up to date every morning about this activity. Next slide, please. So while these were the highlights, explaining a bit more about the business. So Team Internet, through the acquisitions that we've done over the last couple of years, has assembled a portfolio of 45 different brands, and for which we've now found this new roof under the name of Team Internet. But what is maybe more important than the number of brands that we own is on the next slide, which is how many of these brands have leading positions. So Tonic, being the centerpiece of our online marketing business, is the world's leading Google AFD partner. AFD stands for AdSense for Domains, where you basically put Google ads on domain names. Parking Crew is a leading global domain parking platform, helping domain investors recovering their cost. Vergleich.org being the #1 product review portal in German-speaking Europe. Centric Reseller, the second largest domain name distribution network. You've been seeing our competitor, Two Cows Domains, so we are quickly catching up. And conscious of time, CentralLink Registry, the oldest business in the portfolio, basically dating back a quarter century, is still the #1 provider of registry services for so-called NTLDs, which are all these new top-level domains that were introduced after 2012, like .xyz, .icu, .online, or .site, where we have a 45% global market share. Next slide, please. And over all these different assets that we operate, we've basically built a vast array of different types of supply, and also an extensive array of different demand-side partners. And we are constantly growing the categories from which we source our supply, and also the categories how we monetize the supply. And in each of the categories, we're constantly adding new partners to fuel the growth that you've seen before. Next slide, please. So, and while this might have sounded complicated, in the end, the business is very straightforward. You can basically describe both sides of the business with only 2 KPIs. So in online marketing, it's all about visitor sessions, so how many customers actually engage with the customer journeys that we create. And here the number has gone up from 3.5 billion to 5.3 billion. So also just look at these numbers. So the company is actually having more than 100 revenue generating events per second in this business. And RPM stands for revenue per thousand, a typical industry jargon. The more important thing is here that we kept this metric stable, whereas the broader market has come down by roughly 2% in the same time. So here, stability is already progress. And once the next economic cycle comes, we then expect that also this metric will increase dramatically again. Same picture in online presence. So here we measure the number of domain years processed and the revenue per domain year that we process. Both metrics gone up, the volume metric by 7%, the revenue metric by 6%. And the figures on the right-hand side are mostly for retail audience who might not have access to broker reports, but you can digest these numbers and do your own judgment when you later assess our presentation. Next slide, please. Which is a section that Billy will now present to you.
Thank you, Michael. So just looking at the company's income statement in a little more detail, Michael's already indicated that there are highlights throughout the P&L, both right down from gross revenue, top line revenue, through net revenue, which is the term we use for gross profit, through to adjusted EBITDA. You'll see strong growth year on year. It's important to us as well, though, that we're not only delivering strong growth in all the typical operating metrics, but also that flowing down the P&L to operating profit and even below down to profit before tax, which is not on this slide, but we've generated a profit before tax and a profit after tax for the first half of this year. You'll see on this slide that profit that operating profit remains at very competitive levels. So it's important to Michael and myself and the rest of the board that we deliver bottom line profitability, so that the strength of the operating business is reflected in a true bottom line profit that we can then use to enhance shareholder value and return money to shareholders. In respect of the balance sheet of the company, we have a very strong balance sheet, a very manageable level of both gross and net debt. As Michael alluded to earlier, the increase in net debt, which is of course something that we keep a very, very close monitoring analytical eye on. The only reasons why net debt increased in the first half of this year compared to the end of last year, we're used to gradually bringing net debt down periodically, but it increased because of the very bottom bullet there was a non-recurring settlement of deferred contingent consideration in respect of two very successful acquisitions that we've made in recent years, where we're very pleased to have the management of those businesses outperformed the expectations we had when we bought the businesses, and those led to deferred contingent consideration payments, i.e. sharing some of the success of those businesses, which continues into this year. So those are non-recurring payments. They both happen to fall into Q2 of this year, but we're not committed to anything like the same levels of earn-out of contingent consideration payments in the second half of this year. And then as well as that non-recurring cash outflow, we've also made a conscious, deliberate decision to return cash to our shareholders, both in terms of our inaugural dividend, which was paid in Q2, but also in the share buyback program that Michael alluded to earlier. So when you look at the cash outflows in respect of those very manageable and forecast cash outflows, you'll see that without those, net debt would actually have decreased, which is what we're hoping to do in the second half of this year, to show a decrease in net debt through the end of the year. The underlying cash conversion of the business remains very strong. It's always our target as a business to convert adjusted EBITDA into operating cash at least 100%. We overachieved on that score in 2022, and whilst we're slightly below the 100% level in the first half of 2023, partly because of some hangovers in terms of costs which were accrued in 2022 and paid out in 2023. Plus as well the fact that we expect our cash conversion to improve in the second half of this year as we pay careful attention to working capital and to credit terms that have been advanced to new customers. We're hopeful, and the target remains for us to exceed 100% for this year. So 100% will remain the minimum target for cash conversion for us as a business. The final slide in terms of financials is just to draw out a couple of figures which may not receive the attention they deserve within our externally reported financials. I referred earlier to the fact that it's important to us to deliver actual bottom line profitability as a business. You'll see that right down to profit before tax level, we're delivering a profit before tax of 10 million plus. We are continuing to convert net revenue, gross profit into, but our operating leverage improves each year, and we're converting net revenue into a good level of operating profit. Within operating profit itself, you'll notice that there have been a couple of increases within a couple of the cost categories, such as amortization of intangible assets, and that obviously does have an impact on our operating profitability, but that's a non-cash charge because those intangible assets are primarily intangible assets relating to inorganic growth of the business, i.e. M&A activity. So when we've acquired new businesses last year, we've been through naturally a PPA exercise. We've put more intangible assets onto the balance sheet, and those are then amortized away. So the majority of that amortization of intangible assets is a non-cash charge. So some of the charges that you're seeing coming through operating expenses in the first half of 2023 are non-cash. So the underlying profitability of the business and the growth in true operating trends continues to show growth year on year. The final point I'd make in respect of the P&L is that we manage our debt quite carefully. We are comfortably within our debt covenants, and we're at the lower end of the covenants, the metrics that we have to abide by. We do have an interest charge that's paid on that debt each year, but we executed a successful refinancing program in October of last year, where we're able to reduce the coupon on our external debt significantly, and we're seeing the benefit of that this year, because as interest rates have risen, although the variable portion of the new refinancing inevitably increases as it would do in the market, we are paying a significantly lower rate than we would have been if we hadn't refinanced last October. So the timing of that refinancing has proved to work quite significantly in our favour. I'll now pass back over to Michael for the strategy and the outlook.
Thank you, Billy. So I hope you will all agree that this is a strong set of results, and what can the company do to keep it that way? So what we are trying to create here is a virtuous circle, which starts with our strong focus on organic growth, winning new customers, growing the existing relationships, and constantly adding new products and contracting with new suppliers. And this organic growth, coupled with our cost discipline, then leads to operating leverage. So we mentioned the ratio of EBITDA to net revenue increasing from quarter to quarter, and this operating leverage then again translates into more competitive cost of capital. While we've had this major crystallization event through the refinancing last year, Billy just mentioned it on the last slide, we are now turning our focus to the equity side of the equation. Again, I make reference to the share buyback program. Well, again, AI is basically a central component of the company, and it always has been. The file will be made available later for read through. This we will then probably have to skip, but here this is basically how we combine the different assets of the group. And let's then jump straight into Q&A, if you don't mind. Thank you.
Thank you, Michael. Thank you, Billy. So great presentation, lots of detail. We'll have to get you to come and do one of our live events. That will be really good. That will make a lot of sense, actually, for a lot of reasons. But I've got time for a couple of questions anyway. First of all, one person said, was it really necessary to change the CentralNic name? You explain why, but CentralNic is obviously very well known. And was it really necessary to do that? Are things going to change dramatically?
Well, yes, it was absolutely necessary, else we would not have done it. But the CentralNic story has pivoted too much to still conduct it under the same name. And but we are not giving up on the CentralNic brand. So the CentralNic brand will live on as a dedicated brand for our online presence business, which is also where it has recognition in the market. And here I'm talking about the commercial market, not the stock market. And a new name now gives us a new roof, which is more descriptive of what the company is going to be going forward as compared to the 10 years.
And thank you. Which area of the domain sector do you see most growth going forward?
Well, so our specialty is the sale of exotic domain names to international hosting companies, and this is also where we see the growth going. .com is pretty much full. All reasonable combination of letters and numbers have already been registered, and VeriSign, the owner of .com, therefore increases the prices every year because that's the only growth driver. And this is why more and more of the demand goes into country code top-level domains like .uk, .de, .ch, .fr, but also to the more exotic ones like .ai of the island of Anguilla, which is now selling like hot cake, or other ones like .io, the British Indian Ocean Territories, which is popular among digital companies, or .co for Colombia, just as a hip alternative to .com. And this is exactly where the CentralNic part of Team Internet is. And this is also why we now see these exciting growth rates, which are now a full 10% higher than the average of the last 3 years.
Okay. Someone's picked up on the financials. There was one highlight: exceptional costs and share-based payment expenses. Could you just elaborate, Billy, on those?
Yes, certainly. So in terms of non-core operating expenses, which we classify outside adjusted EBITDA, that is a category of spend which we have targeted to decrease over the years. Historically, we have classified a not immaterial amount of costs relating to M&A and integration activity outside of adjusted EBITDA, because those costs are not reflective of the underlying recurring operating cost base of the business. And it continues to some extent into 2023, but at a lower rate. So we're targeting to continue to decrease non-core operating expenses, although we are still incurring, and we're quite happy to incur some M&A related costs. There is a pipeline, there are targets, there are always companies we're looking at, and that's a category of spend which we should never turn off completely. And although there is integration spend which has a benefit for the business in the future, and it's unfortunate those costs aren't capitalizable, but generally those costs relate to activities such as merging platforms for similar businesses we've bought. So that has a payoff and a return before we spend that money. So that's a category of costs that we're looking to decrease over time. The share-based payment expense is a non-cash charge, where we're naturally obliged to calculate the charge and to record it over the vesting period for those options. We're delighted to have issued share options and to continue on an annual basis to issue share options to the majority of our staff globally. And it's really good for us when companies we acquired in the last couple of years, their employees join the share option scheme, our global share option scheme, because it means that they are then invested in the group's profitability and in the group's share price, and not just in their own local targets. So the share-based payment expense may trend up over time, but it's a non-cash charge, and it is an incentive scheme that we're delighted to offer to as many employees as we feel it will appropriately incentivize.
Okay, well, thank you very much for explaining that in detail. I wish you good night, and I thank you very much for your time.
Likewise, look forward to seeing you again.